In 2008, the world witnessed one of the most significant financial crises in modern history. It was a crisis of confidence, a crisis of ethics, and above all, a crisis of regulation. Today, we delve into the evolution and impact of regulatory frameworks in investment banking since that tumultuous time. Understanding how regulations have changed and the effects of these changes is essential for navigating the current and future landscapes of investment banking. Before the crisis, investment banks operated in an environment characterized by minimal regulation. The financial landscape was marked by rapid innovation and the proliferation of complex financial products. Financial innovations such as derivatives and mortgage-backed securities flourished, often without adequate transparency or oversight. Investment banks and other financial institutions engaged in practices that, while profitable in the short term, proved to be disastrously risky. The period leading up to the crisis saw the creation and expansion of a variety of financial instruments designed to maximize profit. Derivatives, mortgage-backed securities, and collateralized debt obligations became staples of the investment banking industry. These instruments were lucrative, offering significant returns on investment. However, the lack of oversight meant that their inherent risks were not properly understood or managed. The use of leverage, borrowing to increase the potential return on investment, became rampant. Investment banks borrowed heavily to invest in these high-risk financial products. This excessive leverage created a fragile financial system where even small losses could lead to significant financial distress. A critical issue in the pre-crisis environment was the lack of transparency. Many financial instruments were so complex that even those who traded them did not fully understand the risks involved. This opacity extended to the balance sheets of financial institutions, where off-balance sheet transactions concealed the true extent of their financial vulnerabilities. Regulatory bodies, limited by outdated frameworks and insufficient resources, struggled to keep pace with the rapid developments in financial markets. The fragmented nature of the regulatory system allowed financial institutions to engage in regulatory arbitrage, exploiting loopholes to maximize profit while minimizing oversight. The combination of high leverage, complex financial instruments, and insufficient oversight set the stage for a financial disaster. As the U.S. housing market began to decline in 2007, the value of mortgage-backed securities plummeted, triggering a chain reaction throughout the financial system. Investors lost faith in the market, leading to a liquidity crisis that threatened the collapse of major financial institutions and the entire global economy. In response to the crisis, governments worldwide scrambled to implement reforms aimed at preventing a recurrence. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in the United States in 2010, became a cornerstone of regulatory change. The Dodd-Frank Act sought to promote financial stability by increasing capital requirements, imposing stress tests, and establishing the Consumer Financial Protection Bureau, CFPB. These measures fundamentally changed the landscape of investment banking. Banks were required to hold higher capital reserves to absorb potential losses, ensuring they were less leveraged and more resilient. Stress tests were introduced to evaluate the ability of banks to withstand economic downturns. The CFPB was established to protect consumers from abusive financial practices. It was tasked with enforcing regulations and promoting transparency in financial products and services. This marked a significant shift towards protecting consumers and enhancing the accountability of financial institutions. A key component of Dodd-Frank was the Volcker Rule, which aimed to restrict the ability of banks to engage in proprietary trading for their own profit rather than on behalf of clients. This rule was designed to reduce risky behavior by limiting speculative activities and ensuring banks focused on serving their customers. It wasn't just the U.S. that took action. Global coordination became essential to create a safer and more stable financial system. The Basel III framework introduced internationally agreed-upon standards for capital and liquidity. Basel III emphasized the need for liquidity and leverage ratios, ensuring that banks could withstand financial shocks. The Basel III standards were a significant step towards a more stable global banking system. They required banks to maintain higher levels of high-quality capital and introduced a leverage ratio to prevent excessive borrowing. Additionally, liquidity coverage ratios were implemented to ensure that banks had sufficient liquid assets to cover short-term obligations. The impacts of these regulations have been profound. Investment banks have had to adapt, often restructuring their business models to comply with the increased scrutiny. The changes have been both positive and challenging, reshaping the landscape of investment banking in several ways. Investment banks have shifted from traditional trading and risk-taking strategies to a focus on advisory and wealth management services. This shift reflects the need to align with the new regulatory environment, which places a premium on stability and risk management. Compliance has become a core part of investment banking strategy. The need to adhere to complex regulatory requirements has led to significant investments in compliance infrastructure and personnel. While compliance costs have surged, the overall risk profile of investment banks has improved, contributing to a more stable financial system. Despite the benefits of increased regulation, some critics argue that these measures may have stifled innovation and made capital markets less competitive. There's a delicate balance between regulation and fostering an environment where innovation can thrive. Some aspects of Dodd-Frank may indeed have limited the ability of banks to take calculated risks, potentially hindering growth and competitiveness. Investment banks are navigating this balance by exploring new avenues for innovation within the regulatory framework. Technology and data analytics are playing an increasingly important role in identifying opportunities and managing risk. As we move forward, new challenges loom on the horizon. The rise of Fintech, cryptocurrency, and decentralized finance calls for a new set of regulations to ensure that innovation does not come at the cost of stability. Fintech companies are revolutionizing the financial industry by offering innovative products and services that challenge traditional banking models. These companies often operate in a regulatory gray area, presenting both opportunities and challenges for regulators. Cryptocurrencies and blockchain technology are reshaping the financial landscape, offering decentralized alternatives to traditional financial systems. The rapid growth of these technologies has outpaced the development of regulatory frameworks, raising concerns about investor protection, market integrity, and systemic risk. In this evolving landscape, regulators need to become more agile, not just to respond to the financial sector, but to understand the new players reshaping the industry. The road ahead will require a balance between empowering innovation and safeguarding the integrity of our financial systems. Regulatory bodies must collaborate with industry stakeholders to develop frameworks that promote innovation while maintaining stability. This includes creating flexible regulations that can adapt to emerging technologies and business models. Global cooperation will continue to be essential in addressing the challenges posed by a rapidly changing financial landscape. International coordination can help ensure that regulatory standards are consistent and effective across borders, reducing the risk of regulatory arbitrage and promoting financial stability. Organizations such as the Financial Stability Board, FSB, and the International Monetary Fund, IMF, play crucial roles in facilitating global cooperation and developing comprehensive strategies to address emerging risks. The evolution of regulatory frameworks in investment banking post-2008 serves as a testament to the lessons learned from one of history's greatest financial crises. As we continue to evolve, so too must our approach to regulation, ensuring that the financial system can both thrive and protect. Investment banks, regulators, and policymakers must work together to strike the right balance between regulation and innovation. By fostering an environment that encourages responsible innovation and robust risk management, we can create a financial system that supports sustainable growth and stability. Join the conversation. Like, subscribe, and share your thoughts below. Let us know how you think regulation should evolve to meet the challenges of the future, and what role investment banks can play in driving innovation while maintaining stability.